So Joanne, the heat is on. You have to do just as well. So let's welcome Joanne to the
Thank you so much. And after that introduction, I'm going to have to really work hard to live up to that. For those of you who don't know me, I'm Joanne Koontz. I'm an attorney at CPA. My office is right down the street on Orange Avenue in Fruitville. I appreciate your time this morning, especially a tax topic first thing on a Monday morning is not prop. I think the only worst would have been maybe last week after the time change.
Yeah.
Right?
Right.
So thank you for coming. I would like to have this be a discussion, so I don't want to talk at you. Your handout is for your reference. Take it home, mark on it, whatever. I'm not going to read to you. That's not how I do things. So if you were familiar, there was a little tiny tweak in the tax law at the end of the year, like right around Christmas. There was a minor adjustment of the tax law. They took the entire thing and put it on its head. This is the largest tax law change since the overhaul in 1986. I won't tell you where I was in 1986 because it was not yet in formal education. Sorry.
You just hit a nerve.
You know, I'm already in bad form here because Darla was telling me that she injured her foot in high heels. And so she was, wagging her finger at me about the shoes. And then I saw that she told me that she actually injured herself wearing flats. So I think it's not the heels that were the problem. It was the lack of heels that actually were the problem. So nonetheless, there was a lot of discussion about the tax law change before it actually took place. So bits and pieces of sometimes what people are saying to me are coming from some of the proposed versions of the legislation. So I'll talk a little bit about that just to clarify any confusion. And if you have questions, fire away. So the purpose of this overhaul was to save money for the taxpayers. And that, according to the folks who study such things, the estimate is that 90% of American taxpayers will save money under the new tax code. 10% are going to pay more, and the good news for you is those 10% are our high-income earners in high-tax states like New York, Connecticut, the Northeast, who may have an opportunity to come down here and buy something. So I want to start out by talking about how this tax impact is going to affect your real estate business, and then we'll tail off at the end and talk about some talking points that you might use for your customers. If you've got people on the fence, I have a poker that you can use to get them off. So, some part of the simplification was they were expecting this tax code to change our current system from 7 brackets to 3. That didn't happen. We're still stuck with 7. The nice thing is that the tax bracket each bracket was decreased. So our top tax bracket was 39.6. Now the top tax bracket is 37%. Bigger deal than that is the floors in which you go up to the next tax bracket in income were all increased. So now it's nearly $100,000 at the top tax bracket that you can earn more before you enter the top tax bracket. So now that $100,000 or so of earnings before you go into the top tax bracket now jumped from 39.6 all the way down to 35 because it's now in the second tier tax bracket instead of the top tier. So when you look at those tax brackets, you go, oh, those really aren't a big difference. The percentages may not be, but the overall impact for you can really, really, really be big. So those are on your schedule more for your perusal than anything. Capital gains rates did not change, but the breakpoints and when you go from 0 to 10 to 15% capital gains rate, those did change, and those are in your materials as well. Some things that did change, standard deduction was doubled. So for folks who are not yet homeowners, they're going to get that benefit. However, personal exemptions went away. So when you hear people say, I claim my kids, or I claim my elderly mother, there was a lot of fraud with that, so they just got rid of it completely. There were sort of lower socioeconomic climates where people were selling Social Security numbers from kids. Like, I couldn't deduct all 5 of my kids, so I'll sell you 2 of our socials. All that now is handled, so hopefully that will help minimize some of the identity theft that was taking place as a result of those types of frauds. Gift tax and estate tax levels doubled, so $11.2 million is the total estate tax before you pay tax when you die. That's a pretty good level. If you failed to die in 2012, and George Steinbrenner did when there was no estate tax, this is a good place to be. Don't check out now, right? The gift tax is $15,000. The exemption is $15,000 per year per person. So if you are trying to get money out of your estate, that's a tool that you'll have available as well. Some things that are different but maybe not better, mortgage interest was limited. So in days gone by, you could deduct the mortgage interest paid on a balance of $1 million on a primary residence. That's now being reduced to $750,000. If you have an existing $1 million mortgage that you've paid the balance down, let's say it's a 5-year-old mortgage and you've paid the balance down to $700,000, you get one free refinance back up to $1 million, and you get to still deduct that interest up to $1 million. Does that make sense? With glassy eyes, is it Monday or no? Okay. State and local tax deduction. Here's a good bit of why you're going to see some migration from up north. State and local tax deduction is an itemized deduction on Schedule A of your tax return, and what that used to allow was deduction of any state income tax, local income tax, real estate tax, and sales tax that was paid in the year by the taxpayer. If you think about somebody in New York who might have $30,000 or $40,000 in real estate, maybe has the same number in income tax, let alone a borough tax or other city tax, they used to deduct that full $60,000, $70,000, $80,000 right off of their Schedule A. That limitation is now $10,000 for all of those types of tax. Very seldom are you going to find a property in New York that's not at $10,000 anyway, so that means they've lost the benefit of deducting their income tax. That's going to help be a little bit of an impetus to kind of push people who are maybe on the fence or have some ability to work remotely to say, go ahead and become a Florida resident and get down here. So we're hoping to see that spur some sales, or maybe people to upgrade from, maybe just a vacation place to a primary residence. You'll see some activity there. Charitable contributions are deductible now at 60% rather than 50% of your total income. Why is that helpful to you? I don't expect you to give away 60% of your wealth, but if you're working with folks on the Barrier Islands who are looking at maybe contributing part of the land that they're looking to buy to build a nice big home, maybe they want to contribute part of a property to a conservation foundation to get a conservation easement. That's good tax planning to deduct protection from anyone building in your view. So that deduction is now limited to 60% of their income rather than 50%. So that means if someone is doing that kind of transaction, they're going to get a nice, healthy deduction faster, which is good news if you're involved in one of those types of transactions. Does that make sense? Mm-hmm. Okay. Other things, HSA, health savings accounts are still deductible, and 529 plans, if you have kids or grandkids that you're saving for. 529 plans historically were only able to be used for higher education, college or up. That's now been opened to K through 12. So if you've got kids at ODA or St. Stephen's or St. Martha's, you're now able to sock some money into there. You can pull up $10,000 a year with no tax.
Do you know if that's just for schooling, or if it can be for like religious education or like other things, or is it only like regular school? It's
K through 12. It can be religious education, but it must be. You can't use it for like maybe Bible study in the summer or something like that. Yeah, they really try to keep that away from like camps and things like that. It's really on the education piece. Okay. Other things, alimony is now no longer going to be deductible for the person who paid it, and no longer included in income for the recipient. So,
wait, say that again.
if you've already, sorry, go first. If you already have an existing divorce decree, your situation stands as it is. But if you are pending divorce after 2018, now if you are the person paying alimony, it is no longer deductible from your tax return like it used to be. And if you are the one receiving the alimony, you no longer have to pay tax and include that in your income. Mm-hmm. And that was previously the rule, was any receipt of alimony was taxable income. Okay? Other things to keep in mind, we've got gambling deduction. You have always been able to deduct the losses on your gambling atrocities to the extent of your winnings. So if you won $5,000 and you lost $10,000, you could deduct that $5,000 and not pay tax on your winnings. Now you not only get to deduct the losses, you also get to deduct travel to and from casinos. Right? So Vegas is up.
I don't care about the flight costs is always
Why are they
up.
working on
I have no idea where that came from.
Yeah.
When they take away some.
Now, there are some things we have to come to reckoning with, and And that's some of our business expenses have changed. So meals and entertainment have always kind of been a term that gets thrown out together. Meals have always been deductible 50% of what you actually spent. Now, meals are still deductible at 50%. Entertainment is gone. Entertainment is no longer deductible. What does that mean for you? Feed people, right? If you take them to the circus, buy them a ticket and a hot dog, right? Feed people, because the meal piece is going to get us into deductibility. You are going to see, obviously, especially in our area, we're right with sports. We have the Bucks, we have the Rays, we've got lots of spring training, we've got the Lightning, we have a lot, let alone arts and all the other types of performances that go on in this area. You're going to see a trend towards, rather than offering group sales or, you used to find, I'm sure you guys have it, the bankers and your affiliate folks that you work with would load up a bus and take people to the Bucks game. That's no longer going to be deductible. How do you think the Bucks feel about that? Right?
If they serve subs on the bus.
How do you think? Serve subs. What I think you're going to find is that the sports teams are going to respond to that and going to start offering what we would expect corporate sponsorships, where for your sponsorship, your name is somewhere. It might be this big, it might be this big, maybe it's on the, on the big screen in the center of the stadium. But you'll find packages where maybe one package is 4 tickets and maybe one package is 20 tickets or whatever. Corporate sponsorships are 100% deductible. You're going to see, some creative response to some of these limitations.
So a lot of agents are doing customer appreciation parties. And like I have one agent that does it on polo grounds and one agent that does it through training events and stuff. So as long as they are also expensing food, but you can only expense the food.
The food portion is going to be all you're going to be able to get. Simply, I'm being a little facetious. Simply serving food doesn't make the whole event deductible. What you're going to see though is, we're going to have to see if the polo grounds will respond and say, okay, now maybe it's on the score sheet, on the billboard where the scores are, that there's, a shout out to Koontz Associates or Michael Saunders and Company, and we welcome these people here to participate today. And you've got to get something in exchange for your tickets where there's recognition of the company that's sponsoring. It doesn't have to necessarily be up on the screen, but you'll see, maybe they'll run a ticker tape or, where it gets lost in the shuffle, that's fine, as long as on your documentation, when you say, I spent $2,000 on spring training tickets, your contract with the Orioles says, 10 times a day, we'll see your name or whatever. There's no rules about how frequently or anything, I'm just throwing it.
But that's sponsorship.
That's sponsorship. Yes?
Gift cards for food? I mean, if you buy gift cards and use them for food for customers or give them to customers for food, is that going to work?
Gift cards are deductible up to $25 per card. Okay. So we literally have a friend who's a CPA in North Carolina, and he does. If he wants to give you $500, you get him in $25 increments. Technically, any gift is only deductible for IRS purposes at $25. So even if you wanted to give me a closing gift of a pair of shoes, and I promise they weren't $25, you're technically only able to deduct the $25. I will say that is grossly not followed. There's quite a bit of interpretation of that rule, but that's the letter of the law. Now, of course, your FREC rules are different, and your broker may have a different rule, but the IRS says you can give a $5,000 gift. You just can only deduct $25. You don't like that?
Well, I was just thinking that if you take them to dinner at someplace and the dinner's $50.
Yes.
That's totally deductible.
That's 50% deductible.
50%. So it's still just $25. If it's $100, though, it would be $50.
Correct.
So
it's 50% of whatever the check is at the meal. Okay. But the gift card is a gift. It's not a meal, even though it's a gift for a meal.
Yeah.
Right.
So you're going to find that $25 limitation if you buy them a gift card to Fleming's. And if you haul them out to Fleming's and you spend $300 on dinner, you're still going to put $300 on your tax return. There's literally a line item underneath it on the business schedule that says 50% comes out as not deductible. So you don't want to put 150 on your tax return, or you're going to get nicked again. You're going to deduct 150, and it's going to show 150 as non-deductible. Okay?
So does your guy in North Carolina give, what is it, $500? So are all of those $25?
Every single one is $25. Yeah. Now, he's, physician heal thyself, right? So, for those of you who have heard me speak before, you know that I've pushed on you the importance of having a PA or a PLLC in the past. Is anybody here a PA or a PLLC already? A handful, nice. For those of you who are not a PA or a PLLC, you have your license in your individual name. So I'm Joanne Koontz, Realtor. And your income and expenses are reported on Schedule C of your personal tax return, right? What's good about that? Cheap and easy to set up, right? The bad part about that is that's the highest tax rate you can possibly pay on the income that you're earning from your real estate activity. So before the new Trump tax law, I was always out stumping saying, you guys need this PLLC or PA. And after the Trump tax law, it's an even bigger deal. So what's the difference between the PLLC and the PA? Does anybody know? A PLLC is a professional limited liability company. It's just an LLC that requires a license to do the job. So you'll see my firm is Koontz & Associates PL. PL was an old designation that you could use instead of PLLC. In order to be a lawyer, I have to have a license, as opposed to a pizza shop or a retail store where you're not licensed, right? You'll see it with realtors, architects, engineers, accountants, anybody with a license. The PA is a professional association. That is a corporation that requires a license to do the job. So they really are kind of counterparts. There's a little bit more paperwork required with a PA than a PLLC in terms of ongoing annual meetings and minutes from those meetings that are required. They're suggested for a PLLC, but they're not required. You'll find if you look at some of the folks who have been in the business for a good bit of time, they're PAs, because until about 10 years ago, FREC didn't allow you to be a PLLC. So your choice 10 years or so ago was Joanne Koontz Realtor or Joanne Koontz PA. You didn't have any other choice. You're still limited on your options in terms of the name. It must be your legal name. If you're Joseph and you go by Joe, you're still going to be Joseph, PLLC. You don't get to shorten your name. But the benefit of the PLLC or the PA is that you have the opportunity to not only pick up liability protection from the state of Florida. So something happens, Morgan & Morgan, for the other people, right? Right? We don't want you to have that liability. And of course, as a lawyer, I always talk about liability, and what do people think? It's not going to happen to me, right? You'll have liability, but not me. So no one buys my PLLC game on liability alone. Let me add too, the benefits of the PLLC. And I say PLLC and PA as though they're interchangeable because essentially they are. You're going to get the same liability protection and you have the same options when it comes to your tax structure. So pre-Trump tax law, I was saying be a PLLC or a PA, and then that's what you build at the state of Florida. If you jump on Sunbiz, everyone familiar with Sunbiz? That's where our Department of State Secretary of Corporations is online. You jump on Sunbiz, you form your PA or your PLLC, boom, right? No, that's the beginning, not the end. No boom yet. That's going to give us liability protection. Next is we jump over to the IRS website and we get our tax protection. Those things are different, okay? So I liken what we do in the state of Florida to dinner and what we do at IRS as dessert. You can pick one of several different types of entities for the state, and you can pick several different options for taxation with IRS. So if we have our PA or our PLLC, we then can go to the IRS and say, how would I like to be taxed? If I'm Joanne Koontz Realtor, I'm taxed on Schedule C. If I have a PLLC and I choose that taxation, that's called disregarded entity. The IRS ignores the fact that there's a PA or a PLLC for tax purposes and puts your income and expenses right back on your personal tax return rather than putting them on a business return. Right? Happy? Okay. Option 2 is to tell the IRS to tax your PLLC or your PA as an S corporation. Does anybody have that? Perfect. Do you know why you have that? No. Okay, good. This is like confession. It's good to be honest. Anybody know why you have the you have an S
You're
corporation.
taxed on the income that you take. Your money is held in your corporation and then you take a salary
Yeah.
from it.
We take a salary, but the big benefit to the S corporation is it allows us to shield 80% of your income or so from 15.3% self-employment tax. So if you are operating your real estate business on Schedule C, you are out of the gate paying 15.3% more in tax than you should be. That was just the pre-Trump tax law. So I've been out here saying this is such a great idea, unless you're Warren Buffett and you'd like to contribute to your community more by paying a higher tax rate, we should not voluntarily go with that Schedule C treatment. I also used to tell people, if you're new to the business or still finding your way, maybe working it part-time, if we are earning about $50,000 in gross commission, the cost of that separate tax return would outrun the tax savings in some cases. So 50,000 was always my magic number for people to say, just generally speaking, no specifics involved. If you are working in real estate making less than 50,000, the PLLC or PA is still a good idea for liability protection, but maybe we're spending $10 to save 12 on the tax return, right? So maybe that's not worth it. Comes December 22nd. Now we have the new tax change. And in addition to saving the 15.3% in self-employment tax, there is an incentive for businesses in this new tax legislation, and that incentive is any flow-through entity, S corporation included, meaning that income is reported on a separate business tax return, but that S corporation is not actually paying any tax. The tax gets paid on your personal tax return, so it flows through from the business to the personal. Any flow-through entity under the new tax law gets the benefit of a 20% business deduction.
Wow.
So now, I don't know, you guys operate percentages pretty well. What's 20% plus another 15.3%? Yeah. So we've got quite a bit of money sitting on the table, planning-wise, that we're able to take advantage of under the new tax law. Let me say the individual changes under this law took effect January 1st for the most part this year and will sunset December 31st of 2025. Okay, so by the time everyone figures it out, we'll go back to the old way, right? There's plenty of time for politicians to get involved and extend or change or modify this, but for right now, the set of rules that we have for individual is for 7 years. The business changes were permanent. So this 20% is not a carrot that's going to get taken away from you. Now I've pretty much taken my income restriction off the table. 50,000 is not the right number. I would say 25, 30,000. If you do one deal, you could make $25,000 without, being crazy. So this is really substantial in its impact on your business. A lot of the courses are teaching you how to work harder, how to use social media, how to use photography and drones. And I don't want you to do more. I just like you to take more home. And this is a very easy way to do so. There's not really any difference in your day-to-day operations. You're still tracking your expenses. You should have been doing that even before you had a company. Otherwise, how do you know what kind of income you're paying tax on, right? We need to be tracking deductions anyways. Now, all you're changing by moving to the S corporation tax treatment is the form that those numbers are reported on. It also helps to reduce your audit risk. There are certain types of categories of expenses, like advertising, for example. Meals and entertainment were always a favorite, and mileage, that have always been a high audit risk category for real estate agents. You do find that the IRS will soften the audit procedures on S corporate returns rather than the Schedule C returns. Things are much less interesting. They don't feel like if there's a real business that you're just shifting personal expenses, dinner with your husband, onto your Schedule C. They feel like those meals and entertainment are probably with a real client. Yeah, let me tell you who the biggest thieves in my office are. It is the business owner. So it's not like these returns are all pure as the eye of the snow, but the IRS feels, if you can say that a big, heartless agency feels, the IRS feels that those are less likely to have instances of fraud. So their audit procedures on those are lower. So that change is enormous and effective immediately. Your requirements in order to obtain a PLLC or a PA are pretty straightforward. We can provide you a list to ensure that you do everything on that list if you're interested in doing so yourself. A lot of people jump on Sunbiz and think that they're done. Sunbiz is easy. It is the start, not the finish. You've got to also get a tax ID number with IRS. You've got to make your S corporation election to tell IRS you want to be taxed this way. You've got to actually apply and get a new license from FREC. You're going to file an RE16 form that's going to move your license from your individual name into the company. You then have to notify the broker that you've made this change. You can't do it in the dark of night without letting anyone know. We need a separate bank account because we can't commingle our funds. If you've had a separate bank account that you've been using for business expenses, is that going to work? No, because that's still an individual account. It was opened prior to the existence of the business, so it's definitely not an account that belongs to your business with its new name and its new tax ID number. Okay. Sometimes people say, well, I have an existing LLC, can I just use that? Maybe. Sometimes the finagling to get that working and get it modified to meet the requirements for FREC is just as much time and hassle or money as starting from scratch. It will just depend. I will say, if you do form a PLLC or a PA, all of that activity in there needs to be restricted to 475 commission income. You can't put a rental property in there or a consulting business or any other kind of activity. All you want to see in there is activity from your real estate business. Everything can go in there, pay photography, pay super key fees, pay your raising fees, all of that stuff you can pay through the business account, but those things do need to be, real estate business only.
But if you form your PLLC mid-year, you cannot, it's got to be from the time you have that form.
If you form your PLLC mid-year, any commissions that you earn from day one until your real estate license is actually transferred are going to be issued on a 1099 to your Social Security number, and then you'll receive a second 1099 to the EIN number of the PLLC for the balance of the year's transactions. Sunbiz is taking about 2 to 3 business days to get us back confirmation. Once we push the button and form the company, it takes about 2 to 3 days to get back that confirmation. FREC's taking 21 days solid. There's nothing I can do to speed them up. There's no expedite fee. The only thing that I can do to make your FREC application move faster is FedEx it to Tallahassee rather than mail it. So you get in the stack on the pile quicker. That's all I can do to speed it up.
Can't you do that online now?
No, not that I'm aware of. Let me say that. Something could have changed in the last few weeks. If you can, I would be happy to do that. And then I learned something today.
I think you can. I think because when I was on the commission, I think we changed that.
Okay.
I think.
Okay.
I'll double check.
I will
I'll
run
let
back
you
and
know.
check as soon as we finish, because if so, that obviously helps. Their processing time is still 21 days.
Yeah.
And like I said, there's no expedite fee. So you have to be mindful. Some people say, oh yeah, I'm going to get to it. And it's like doing the will and all the other stuff that's not any fun. You put it off. And then what happens is we have a really big transaction, and then they call me fretting and say, oh my gosh, you have to hurry up. Or I get the other bonus suggestion of, well, I'll just tell Darla not to pay me until it's done. You earn the commission on the day of closing, so, and you are with the wrong broker to try to play games with. So unless you go to your customer and say, we need to extend closing for my tax planning purposes, you're going to miss the bus. So, right? I haven't seen one of those go over successfully quite yet, but nonetheless. Other questions?
I have a question.
Yeah.
You mentioned something about meetings and taking minutes. How
Yes.
do we do that with ourselves?
With yourself. It seems really silly. I do have a form. If you are a PA, I do have a form that you can fill out. And if you say, ooh, I haven't done that in 5 years, it's fine to go back and re-elect yourself as the officer. And, it seems silly. But I can tell you that Morgan & Morgan, that's one of the things they look for. Because what you want to avoid is looking like it's just you. When a lawyer is trying to pierce the corporate veil or get inside the protection of the company to get at you personally for liability, their number one weapon to do so is called piercing the corporate veil. And the way to pierce the corporate veil is to tell the court, look, this is an alter ego. I can't tell the difference between Joanne Koontz and Joanne Koontz PLLC. They're the same. It's just a nickname. It's just another name, but she shouldn't get the liability protection. Commingling your funds, paying business expenses from your personal account and paying personal expenses from your business account is the number one way to get that upended. The number 2 way is to look like there's no difference by not having an operating agreement for your LLC or bylaws for your corporation and not taking minutes. If you are a corporation, if you are a PA, holding that annual meeting and taking those minutes is a requirement. Now, if you fail to have the minutes, does that mean you're liable for everything? No. It's a facts and circumstances test, and they look at the totality of the circumstances. If you commingle and you don't have minutes and you don't have bylaws and, you don't look like a separate company. If that's the only place that you've stumbled, you can probably overcome that. It's going to be at the judge's discretion or jury, depending on the type of trial that you're in. But my point is, let's button up all of those administrative things and not leave ourselves to have to argue about them. The benefit if you're getting started and you've done nothing about the PLLC is that's a suggestion but not a requirement. So the judge can't wag his finger at you and say you're missing this if you don't have it. If you've had a company, if you've had a PA for 5 or 10 years and you've never done this, you can go paper it up right now and do 10 years of minutes in this weekend and be fine. You cannot do 10 years of minutes in anticipation of litigation. So once someone's threatened you or has actually filed a lawsuit, the judge does not think it's cute to see 10 years of minutes dated this weekend. And there is, the metadata tag, so they can tell in Microsoft Word when you created the document. Yes?
So you can do an S corp whether you're a PA or an LLC.
Correct.
What would be the defining factor to choose one over the other?
Do you want to do minutes and keep, and have this annual meeting? That's really, the administrative requirement difference really boils down to
But you
that.
still get the same 35% advantage from a tax.
Correct.
And you still
Because
have
the tax is still, as an S
separate.
corporation, it's exact same election on the tax return, you've just taken a different house for the business, a different
So
structure.
why do the PA if you can do the PLLC for the same benefit?
Because A, people don't know about it, and if you're DIYing, which you'll note if you guys are familiar with HGTV, there's a lot of DIY like bathrooms and kitchens, but there's no DIY legal work show because it's not pretty to see at the end. But sometimes people do it on their own, and they're like, oh, well, I see that so-and-so who's been an agent for 25 years as a PA, that must be the right thing to do.
Okay.
There is a bit of a herd mentality inside your industry where people will come to me when I'm like, hey, you're using your team indication wrong, or you can't say that on a business card. And they're like, well, so-and-so's doing it, and they're a top performing team. Like, I don't know, that's so wrong. So,
Okay.
oftentimes it's copycat syndrome where people just do something because they've seen it. So plenty of PLLCs around now, but I still think if you don't know anything about it, people are more familiar with PA.
We just started a program this year, brand new, where we are at the end of the year awarding bonuses to agents based on levels of production. How are those bonuses?
Those bonuses,
They're self-employed.
But the bonuses are being paid to the licensee, correct?
Correct.
That it's still going to roll through. It's going to show up on their regular 1099 as though it was regular commission income, and it's going to be included in their S corp return, exempt from those taxes.
Okay. And then the second question, under other provisions, with all due respect to the assistants sitting in the audience,
Please.
that it says employee awards in the form of cash, gift cards, coupons, vacation. How does that apply? Like if I am a licensee, but I have a paid salaried assistant?
If you have a paid salaried assistant, that's way different than having a 1099 independent contractor. And let me say that the differences there lie in the nature of the relationship, not how your assistant has insisted on being paid. Some people are like, oh, you have to take taxes out or I won't work for you. Some people say, I want to do my own thing, please don't take taxes out. The Department of Labor does not think that's the test. So be very careful when you are determining if someone is an employee or an independent contractor, because more probably stringent even than the IRS tests, the Department of Labor tests, and their penalties are outrageous. To get back to your question and your point, if you have an employee, those perks can go then in under payroll. So some of those things that you do will be included in your payroll expense and they'll be fully deductible, rather than putting them with gifts where you're going to be subject to the $25 limitation. So you do have some benefit there. Okay? Yeah.
So as long as you have your income as a realtor coming to you in your name, and it goes through your LLC,
that's a business, that's part of the LLC and you're getting paid from.
You cannot get, let me clean up language, you cannot get paid in your name. You have to get paid in the PLLC name. Then once your commission check comes, you deposit it into the PLLC checking account. Then you pay whatever business expenses you want, and if you need to pay your mortgage, you need to pay your personal expenses, you then transfer or write a check to yourself for whatever dollar amount you need, $5,000 for example. You either cut a check and deposit it into your personal account, or you do a transfer online, fine, either way. Then you pay your mortgage and your car payment and all the things that you're gonna pay personally.
So your license has to say, which it, got that in whatever the LLC. But then LLC, and then it goes into that account. All the payments do.
Mm-hmm.
So what if I have a license someplace else and put that money through that same LLC?
You mean in another state?
Mm-hmm.
No, this can only be the only purpose of this PLLC is to hold your Florida license. So when you think about the PLLC becoming the licensee, it is truly, you strip the individual of the license. So it is no longer appropriate to have your name on anything. You are not individually a licensee, just like I'm not. You don't see Joanne Koontz's name on any signage because I'm not a licensee. The second you go from your individual name to the PLLC or the PA, you no longer are the licensee. So you can't mix businesses, you can't mix types of income, you can't mix with a license in another state. If you have a license in another state, for example, I just spoke at Triple Play in New Jersey, and that was New York, New Jersey, and Pennsylvania. Pennsylvania and New Jersey are on the Florida mindset, allowing the PLLC and letting us do it. New York won't let them touch it. There's nothing I can do to help the New York people, who, by the way, are in the top tax bracket, paying this and now having the $10,000 limitation. There's nothing I can do to help those folks because their state says you can't put a license in a company. So each state's going to have its own rules, and Florida is required to be a Florida PLLC in order to do that. So you couldn't take, for example, an Ohio real estate license and run the activity through your Florida PLLC.
And just remember that the minute you get that PLLC or PA designation, as well, you need to notify Michael Saunders and
Right.
company too,
Mm-hmm.
because the commission checks will
Have to
be
be
made
changed.
out to that PLLC.
Let me say too, this seems to go without saying, but one of the other alter ego arguments is people don't use the business name. I can't tell you how many times I form a company, real estate or not. We just did one recently, and I used my client's services for a party we had last week, and we put her business cards out to advertise her, and I look at the card, and there's no indication of LLC anywhere. I'm like, what do I have to say? You have to use the name of the company if you would like protection from Florida law. In addition, if you would like to not get a letter from FRAC, you need to use the company name because that is the licensee. That means signs change, business cards change, your name in your software changes so that the listing agent or the selling agent is now no longer listed as Joanne Koontz, because who's Joanne Koontz? I don't know, but she's not a licensee. Joanne Koontz PLLC is the licensee, and that's how I need to sign my listing agreements.
And we have even charged associates at FRAP for unlicensed activity when they were doing business as Darla First, when they were really Darla First PLLC.
So you think my sign, my real estate sign should say Marcia Salkin, PA?
Yes.
Not only should, are required to.
I don't think they do.
Any advertising, any marketing, anything need to say PA or PLLC.
Because if it doesn't, you're not using the business's name. So FRAC's big shtick is they don't want you to mislead the public. Florida law is if you want protection as a business, I need to know you are a business, and I can't tell if you don't use the business's name. You also you have to be careful where you're getting your advice too, because you might visit with a business lawyer who says, oh, that's fine, just do a DBA and we'll drop the PA and you'll be fine. That is fine, but FREC's going to give you noise about it. FREC says no DBA because they don't want to mislead the public. So if you're a pizza shop, that's exactly what I would do, is do a DBA without the LLC name, and then it doesn't matter if someone refers to you as the company without the LLC designation. But FREC's going to tell you you have a limitation there. So you need someone who's familiar with business rules, familiar with tax rules, and familiar with FREC rules. Otherwise, you can get caught in the crosshairs because these three agencies are not concerned with each other. So the rules don't make sense, they don't overlap, In fact, some of them contradict. FREC says you've got to put your PA designation on there, but to my understanding, there's no requirement on size.
I think that's about to change.
It should.
We're changing, as you know, they haven't voted it, well, they have voted it, but they haven't made it effective yet. But there's gonna be some major changes with regard to teams and advertising, because we've had big issues with that.
We're still not gonna
Is
license
that
them
gonna be
though.
favorable or not favorable?
It's just gonna be more detailed.
Anybody here on a team? On a team here? Anybody? Couple? So the other thing to keep in mind with teams when it comes to all of this PLLC discussion is if you would like to form an LLC for your team, you can. You should. And I'll talk about why in just a second. But you cannot form a PLLC for your team. Do we know why? Because it doesn't have a license. FREC won't license teams. So your team Koontz cannot be a PLLC. It must be a regular LLC, right? Just like the pizza shop. The benefit there, particularly with non-family teams, if you are a spouse team, you're going to get some benefit there. If you are not, if we are on a team, the downfall to not having a team registered as an LLC is if you're out driving along Moquis, texting and driving, and you mow over some tourists, I'm going to be liable. I'm going to be liable. Because they're going to say, hey, you held yourself out in business with her, therefore you're liable for her actions in business, and that's a liability I can't insure. If we form Team Koontz, then you can be out, you can mow everybody over, and I can have insurance for it. So you want to be mindful from a liability standpoint for my spouse teams. If what you can do there is have each of you have a PLLC and disregard that PLLC for tax purposes, and then form a team LLC that the two PLLCs are the owners of rather than the individuals. Then you only S corporation elect the team, because all of the income will then roll up into the team. So if I make a commission check, or my husband makes a commission check, we both contribute them up to the team LLC and then pay all the business expenses out of there. So it's okay from a tax perspective to have just one S corporation level at that team level, and that saves us a little bit administratively instead of both spouses having an S corp return.
Every month we pay X number of dollars to Michael Saunders for professional liability coverage. What, from a suit standpoint, you're just talking about, how are we protected with just that coverage?
On a team, you're not.
No, but as a person, as an individual.
Yeah, as an individual, it's covered, well, you can say probably even better than me. Your coverage is from dumb things. Yes, Mr. Jones, there's plenty of room for a pool, right? It's not mowing people over with the car. So, it sounds terrible.
But if I do something in the course of business, a contract,
Correct.
then I'm covered.
As long, and if you read your E&O policy, as long as it's not fraud or negligence. If it's fraud, if it's proven that you fraudulently did something or you negligently did something, then you're not covered.
Now, let's say you're all a nice group of people, I'm sure no one's committing fraud. But do you want to be on the other side of an insurance adjuster arguing that you were negligent? That you should have told Mr. Jones, who's from New York, Connecticut, New Jersey, Ohio, Michigan, Indiana, that this was going to happen? You're the professional. You should know better. You should have guided them. That's what the
I
other
mean,
side's doing.
obviously, unless it's blatant, we're going to try to say it wasn't
Sure.
negligence, as your broker, but if it's proven that it was sheer negligence.
Okay.
And there's a person at the insurance company whose entire job is to deny claims.
Yes.
Yeah.
So when I talk about LLC coverage, I liken insurance to long underwear. It's great. I would have it. If I were skiing, I wouldn't take it with me, but it wouldn't be all that I wear. The LLC is my big coat.
Oh, the LLC is your big coat.
The LLC is that like marshmallow coat where you can't move. But that's, it's still not bulletproof, but it's the best thing I can give you. You're going to be out and about. You're going to make mistakes. That's the problem with being a human being. We do make mistakes. But like Darla said, fraud, most people are not even towing the line for fraud. I'm not worried about that in your general day-to-day, but I am worried about what some crafty, shady insurance lawyer can argue is deemed negligent.
Right, exactly.
Other questions? Let me also say a couple of things when it comes to talking to your customers. There are some talking points on, I think, the last page. Yes. So I've got here listed the state and local tax deduction, that $10,000 deduction. That's something that should help your northerners, get off the fence. Home equity lines of credit are repealed. They are no longer tax deductible. Even if you've had a HELOC for 5 years, now as of January 1st, they're no longer deductible. Unless, and if you're working with investors, this is something good to keep in the back of your mind. Not that you want to be out there dispensing tax advice, but know when you hear these objections that you can push them back to a tax professional if need be. If you have an investor, they can take a HELOC even on their primary residence as long as we can trace the funds to a business use, to the purchase of that property or to the remodel of that property. That interest is now deductible and it follows the business use. So let's say they're buying a rental property and they need to gut it and completely redo the kitchen. All of the expense for that, the interest, is going to go to Schedule E, where the rental income and expense would otherwise appear. So don't let them tell you no. Say, well, no, why? Oh, well, because now it's not deductible. I don't want to lose out. Well, maybe they don't have to. You're not the right guy to answer if this is the situation in which it works, but at least point them back to their professionals so they can have that conversation. I will say, particularly in our area, there was an extension for the 2016 deadline for filing the tax returns because of Hurricane Irma to January 31st. As you might be aware, that coincides with our filing obligations for 2017. So the CPAs here are a little bit busy and not really interested in dealing with this 2018 change yet. They want to get all the 2016 stuff out of their way. I do have people in my office who have already filed 17, and I have a pile of 16 returns that haven't been picked up yet. So if you think just because the deadline passed, it was January 31st, that we're out of the woods, it's wrong. So you can't rely and say, well, Mr. Investor is savvy and has professionals, so he probably knows that already. Not all of these professionals are being so proactive to harp on all of the changes and get people moving. So those are some talking points to be mindful of. The gain on the sale of principal residence exclusion, that 2 out of the last 5 years, $500,000 is deductible, is excluded from gain on the sale of a primary residence. Y'all are familiar with that, yeah? That was on the chopping block. For a good bit of the negotiation of the tax law, that was supposed to go away. Thank your friends at your RPAC, because it's safe. People don't necessarily always know that. Why do you care? That sounds like people don't want to sell, right? No. If you've got somebody who's been on the fence about selling, this may be an opportunity for you again to nudge them back to the CPA to have a discussion. The IRS rule is gain on sale of principal residence. What does principal residence mean? It's the IRS. It doesn't even necessarily mean the place you live right now. So you may be able to use this if you've got somebody that you've been kicking the can down the road with. This may be the way to get them to finally list and get going. Principal residence definition is the property that served as their primary residence or their main home for a period of 2 out of the last 5 years. What does that mean? In 2018, that means 17, 16, 15, 14, 13. They could have lived in this property as their primary residence in 2013 and 14 and have been renting it since. It still qualifies as a primary residence. So if you're dealing with somebody with a substantial gain and they failed to sell in 2018 because they moved out in 14, if they went into 19, they would lose 2013 because the calendar keeps rolling. That 5-year period keeps moving. If they sell in 2018, up to $500,000 gain, completely tax-free. If they sell in 2019, capital gains on the whole thing. The financial piece of that puzzle can be enormous depending on what kind of gain they're looking at. If somebody's inherited a property in a divorce where they've got a low basis, maybe they were married 20, 25 years and they got the property in the divorce and they paid $300,000 and now it's worth $1 million. This is exactly the kind of person who we need to have in mind. Again, do you need to sit and do the analysis? No. But say, hey, Susie, you might want to get this thing listed and get rid of it. This gain on the sale of the principal residence deduction can be used every 2 years. Now you have to put a break. You can't go 2 years back to back. You can't use it in 18 and 20, but you could use it in 18 and 21. So if they've moved out of that house into a new house, they could sell the old house and then 3 years later sell the new house and still have that gain on the sale exclusion. If they're single, it's $250,000 instead of $500,000. So that's a big number that allows them to spend more if they buy something else because they didn't give it to the IRS.
Let me just piggyback on that, put my Realtor Association hat on, because she slipped that in there, and I want you to really understand the importance of it. She talked about RPAC. This was huge. This was one of the things that they were going to do away with, on the top of the list. And your National Realtor Association lobbied hard and long for this. I mean, again, this is an announcement, kind of a paid political announcement, but your RPAC funds help that. I don't think people understand that the lobbying group for the Realtor Association is the largest, most funded lobbying association in this country. And that means the lobbyists are the strongest in this country. So when you get that little $99, that's on your dues, and you say, oh, I don't need to pay that, that's your business insurance. That's literally protecting you and your customer base from things like this that get lobbied long and hard and strong for. So I tell everybody, that's your business insurance. There's a statistical flow chart of how much RPAC funds have saved your consumer over the last 10 years. And on an average transaction, it amounts to almost $3,000. And that's on a $250,000 to $300,000 transaction. So don't just bypass that RPAC donation.
And that's a pretty good return. So if you went to Vegas,
And you can write it off.
Dr. Casino trip. Let me say also, 1031 exchanges were up on the chopping block as well, and those essentially survived for your purposes. There were some changes. The biggest one that would relate to a real estate practice is that now 1031s are limited to real property only. In English, what does that mean? No tangible goods. So if you're selling a turnkey furnished beachfront rental, the furniture value has to come out of that 1031. They can't roll that as well. It's minor in terms of dollars. That's really otherwise the only thing that has changed for your purposes. In the grand scheme of 1031s, lots changed, but not what you're going to see in a typical residential setting. So, yeah.
You mentioned in the last page something about the rentals and investment property that they can now deduct most of the improvements and renovations.
Correct.
Was that something that they couldn't deduct before?
It's not that they
had investment property or rental property.
It's not that they weren't deductible before, it's that now the different types of, there's four different types of depreciation. There's regular, there's bonus, there's 179, and those different types of depreciation apply to different types of assets. Some are only for newly purchased things. You couldn't buy the furniture in the existing rental because it wasn't brand new. Some applied to stuff that was used but had to be placed in service by a certain date. There were all kinds of funky rules. Essentially what this tax law did was put everything on the same playing field. So it doesn't matter if you are using 179 or using bonus. You can expense, if you remodeled the kitchen, in some circumstances, you had to depreciate that over 27 and a half years, straight line on a residential rental property. Now it comes off this year that you spent the money. Historically, that's not really been the case. So the timing in which that's deductible, instead of waiting for a little piece each year, it's now all front-loaded, which is really nice, particularly if you've got somebody who doesn't hold properties for a really long time. They're never going to get that 27 and a half years because they're only going to hold it maybe 3 years. Now they get to keep deducting that. When they sell it, the next guy gets it. And he can deduct it. The next guy can deduct it. So it keeps the theory is it will keep the flow moving of transactions. There was a lot of this that was real estate related and beneficial, but like I said, with entertainment being a little bit of a knock, we've got to be mindful there. And don't lose your 20% and your 15.3%. If you have no questions, I thank you so much for your attention.